The most dangerous part of the global financial system isn't the stock market bubble you see on the news. It's the $2 trillion ghost economy hiding in the shadows, where the rules of gravity have been quietly suspended, while you've been distracted by AI hype and political theater. The plumbing of the entire world has been rebuilt on unregulated leverage that is currently screaming toward a brick wall. To understand how we got here, you have to look past the Federal Reserve, toward the adult in the room that recently pulled the plug on the party. The bond market. For 30 years, the global financial system was held together by a kind of financial duct tape originating in Japan. After their own asset bubble burst in the 90s, Japan superglued interest rates to the floor, essentially becoming the world's ATM. Investors would borrow yen at near zero rates, buying everything from US treasuries to tech stocks. This yen carry trade acted like global Wi-Fi. It was the invisible signal providing the liquidity that allowed the modern world to run. But in 2024, that free money assumption broke. As Japanese yields rise, the math has flipped. The cheapest source of liquidity on the planet is no longer cheap. The Fed controls short-term rates, but long-term yields follow supply and demand. When Japan steps back, yields have to rise. This creates a steepening yield curve. Borrowing costs stay elevated even if the Fed cuts rates. This liquidity oxygen is now thinning out. A massive credit wave is about to hit. Enter the ghost economy, private credit. This is a $2 trillion asset class, operating almost entirely in the dark. Loans for companies too complex for Wall Street. These loans don't trade on an open exchange. They are valued using level 3 accounting, not what someone is actually willing to pay. The scary part is that these loans are almost all floating rate. The interest moved in lockstep with SOFR. Companies are finding their interest payments have doubled or tripled. We've already seen the first cockroaches. Companies like Pluralsight saw their billion-dollar debt become unsustainable, forcing lenders to step in and take over the business. But if defaults are hitting record highs, why does the data look so calm? The ghost economy has invented a way to make bad math disappear. The payment in kind, or PIK feature. The borrower adds unpaid interest to the principal balance. In the real world, if you don't pay your mortgage, you're in default. In the ghost economy, they call it paying in kind. Many of these lenders are structured as business development companies. They are legally required to pay out 90% of their income. The fund reports phantom interest as income. They mail out a cash dividend using money they never collected. We are watching companies sliding toward insolvency being reported as healthy income-generating assets. PIK features have surged by over 72% since 2021. Around 11% of the private credit market is now running on phantom income, nearly 15 cents of every dollar reported as profit. Interest that nobody actually paid in cash. When you see one cockroach, there are probably more. You might think you're safe because you don't invest in shadow banking. The rules of the game have been rewritten. You are the buyer of last resort. NASDAQ introduced the fast entry rule, modified free float requirements, massive, unprofitable companies can be fast-tracked into major indices. 63% of all U.S. stock funds are now held by passive indexers, more than $13 trillion of blind money. These funds are legally required to buy it regardless of the price. We've built a conveyor belt moving shares from insiders to your retirement account. The historical parallels are hard to ignore. Investors fell in love with one-decision stocks called the Nifty 50. Buy and never sell. People convinced themselves the valuations didn't matter. Some trading at 80 or 90 times earnings. Many of these stocks lost 70 to 90% of their value. The market took 8 years to recover. Today, the Magnificent Seven make up over 30% of the S&P 500, trading at valuations that assume they will grow forever. This time it's different. History doesn't repeat. It rhymes. We are staring at an $85 billion maturity wall between 2026 and 2029. The accounting tricks will finally hit the reality of the math. The adult in the room isn't coming to save the party, they turned off the lights. If you want to understand the mechanics of the markets before the headlines catch up, hit subscribe.